Right, all right, Yield Nerds, episode 180. As you can see, my brilliant algorithm had something of the order of sitting on the edge of the branch while sawing on the inside of the money tree in front of the New York Stock Exchange. I had a major wake-up call. I will share with you my aha moment and tell you all about how my portfolio and my algorithm is doing. Thank you for listening. We're up to 496 subscribers. Untold riches await me, major sponsorships, and I hear talking engagements in major TV networks once I reach 500. So I'm excited about it. If you are new to this show, we have the income investing roadmap, which follows the show in the chronological order. It starts from people who are new to fixed income investing, which is kind of my jam and my passion project. There are a couple of other, playlists as well. I would encourage you to look at them too. And finally, I want to make sure you know that I have no magical powers of prediction. So please check my work and make your own decisions. Four parts. We'll look at how my portfolio is doing compared to the market. I compare myself to the NASDAQ. And the yield curve has, in my opinion, been asleep for several weeks now. We'll see if it woke up or not. And I have my pet project, which is the algorithm I'm trying to develop as I try to go more into equities. I'll share with you my big lesson that I learned there and also share my holdings. Well, first of all, everything I show you, I compare myself to the NASDAQ. However, I do hold stocks in every single sector. That is something that I try to do, not too intentionally, but it does happen that way because I use certain filters. But the point I want to make is, in theory, my volatility would be lower because my holdings are distributed across all sectors. But I'd like for my performance to be as good as the Nasdaq. That's what I'm trying to do. As you can see, I'm slowly but surely increasing my holdings on the equity side and picking and choosing which ones to buy. My asset allocation, however, is very defensive. I own a whopping 50 something percentage of my portfolio still in treasuries, and most of those, around 70% of that, is in short term 3 and 6 month treasuries because I'm waiting for some kind of crack in the treasury market. I hate to put it that way. I do have a minuscule 4.6% allocation to stocks, but that is growing. 20% of my portfolio is in muni bonds where I'm trying to get some tax advantages. And lastly, I have agency bonds for about 11% and corporate bonds, investment grade corporate bonds trading far below par. And the reason I own them is because I expect the market to rush there once interest rates decrease, because you've got to make your yield somewhere. So I expect the market to run towards corporate bonds that are trading below par, but paying a decent coupon. So I'll tell you what I'm looking for there as well. Well, my bond portfolio is very sleepy. It's about 1.7% over 3 months, and I'm happy with the way it is. I'm not looking to suddenly make rash moves there, as you know. That's kind of my yoga stance on bonds. My equity portfolio, however, I have to admit, I got too excited. When gold crashed, you can see right here, I had a 2x advantage over NASDAQ, and my world came crashing down in a few short days. Now, I want to tell you what happened, what I did, and how I have changed my strategy. And I would love to hear your advice if you have different advice as well. Luckily, it was not a completely downward turn forever. I very quickly have regained my footing and I continue my advantage against the NASDAQ, so we'll see. Let me just cover the yield curve one more time. I kind of look at it all the time because I want to make sure I'm investing smartly. Before I share my investment strategy, I want to make sure you know that I'm not an investment management advisor or a wealth management advisor. I don't endorse products or politics, so please make sure that you look at this as education and not advice. Well, the yield curve continues to show this significant buckle in the middle. And what is also happening is that 1027, today's yield curve is the gray line. Uniformly, the entire yield curve is coming down. That is the market saying, hey, I know interest rates are going to come down. And in theory, the market is celebrating some sort of a victory. Because as you can imagine, in the next few months, assuming things go according to currently announced plans, if the front end of the curve drops dramatically, if the FOMC starts dropping interest rates very, very rapidly, then you will indeed have an uninverted yield curve, except the long end yields, as crazy as it sounds, may only be 3.8%. Well, 3.8% for the 10-year, may sound like too little. Now, history would indicate that, it kind of sort of is something you can accept, but it still is a terrifying reality because that kind of yield would mean that a lot of the people who are trying to invest on the long duration of the bond today would indeed be winners because their holdings will appreciate because they might have bought it at a 4.5%. However, if you are trying to extend duration, you're in trouble. So let's talk about what that means. Some could argue, well, let's extend the duration now so I don't see my long-term yields come down again and again and again. And I would very gently remind the listener that, we have something of the order of 9 trillion in debt maturing, and those have to be reissued. They are not going to be reissued in the short end right now. Now, they may be reissued a little bit here while the market waits for the short-end rates to come down, but eventually those will have to be reissued on the longer side. Now, what's a way to keep longer-term interest rates low? You could do what is called quantitative easing. Quantitative easing is a fancy way of saying money printing. If you printed money, the US dollar would go down. If the US dollar goes down, then in theory, the confidence in the US being able to pay a higher and higher debt would go down, and that may cause, the fancy word is bear steepening, the yield to go up. So I don't know which way it's going to go. And when in trouble, especially in treasuries, I just freeze and stay in the short end. That is what I have been doing. I don't know whether it is right or not. I certainly am not going to the belly of the curve. That looks terrible. So I have my allocations in the long end. I have my allocations in the short end, and I just sit and wait. But I run a couple of filters. What is my bond filter? The very first one is I'll say, hey, I know all of you people will run towards yield. And if the treasury yield goes down, the next place where you can go get a higher yield, even though it's more risk, would be corporate bonds. And there, if I sit nicely on investment grade corporate bonds, then if they are trading at 70, 80, 90 cents on the dollar, those should appreciate. Now, what if they don't appreciate? Well, I got a problem. That is why I look for high coupon investment grade corporate bonds. I look for really high yield to maturity. And here is a simple reason. If I can make 4% on the treasury, depending on what your federal income tax rate is, you need to be able to make much more in corporate so you can pay your federal income tax rate. Plus, corporate bonds are a higher risk. So you may attach your own version of a risk premium on corporate bonds. So in a hypothetical example, if your interest rate, if your tax rate, marginal tax rate is 20%, I'm just using a simple example, then a 4% treasury, which is federal tax free, is really like 4 divided by 0.8. 4 divided by 0.8 is like 5%. So the corporate bond has to pay at least 5% to be on par with the treasury, assuming the corporate bond is the same risk as the treasury, which it is not. So you may say, I need to be paid more than 5%. So you're going to make these calculations yourself. Now, when it comes to muni bonds, those are already federal tax exempt. So I'm happy getting a 4.25% coupon only because it's slightly more risk than the treasury. If the treasury is going to 3.99, maybe I'll take 4.125. I don't know. Um, and so I will buy longer duration muni bonds, but they have to compensate me. And off late, neither one of these has produced a match. So I have bought very few bonds lately. And I just keep renewing on the short term, waiting for the right time. In the meanwhile, I've been tweaking my algorithm. Now, let me tell you about my algorithm. I still use two filters. I look for fast growing companies, and off late, I've started incorporating companies in the major indices, which means the NASDAQ, the S&P 500, the Russell, and so on. And so, if something is a fast growing company and they don't have a lot of debt, and they are part of one of the indices, or they are part of one of the indices, that gives me about 100, 200 something companies. It's very easy to day trade on one stock. It's far more complex to do it on 200 stocks. And that is what I have set out to do. And my algorithm creates an exponential moving average, and there is a decay factor, and it looks for, hey, is that stock trending in the right way? And what I'm trying to catch is what is called the MACD crossover. So if indeed the histogram goes from a negative to a positive value, I want to wake up to that and start accumulating. And that is what I'm trying to do. I haven't yet shared my spreadsheet only because I'm finding errors. And so I want to make sure that I'm carefully fixing them before I share. But I'm looking for what is called the crossover point. And once I start accumulating, I then set stop limits. And I learned my big lesson in a couple of areas. My stop limit did not hold, it went right through it. So these days I do trailing stops. And trailing stops essentially issue a market order when the price goes below a certain percentage. And so it sets the maximum on how much I'm willing to lose. And so here is what has been happening up to this date on my trades. When there is a lot of dips in the market, which happens sometimes, things that I held at a profit, and yeah, as you can see, some of these are 100% profit and 70% profit. I believe this is Newmont Gold. And so when things accumulate a huge amount of profit and all of a sudden one day they drop by 10%, I'm just using 10% as an example, it would be whatever your trailing stop is or your stop limit is, the system immediately creates a sell order. And if I'm at a gain and I sell, I'm going to have a realized gain. Well, realized gain means you have to pay taxes, so be careful. But what it also means is I get a whole bunch of these teeny tiny losses that go in. And as you can see, my losses are concentrated in the sub 10%. And I'm going to go back one page. My gains are concentrated in the 25%. So overall, I'm doing well. When I win by 25%. When I lose by 10%. So I'm kind of straddling in that area. Approximately 70% of the trades are trades with where I make a gain, and the size of the gain is bigger. So I'm somewhat happy with my algorithm, but I did fail miserably in one specific area. That's what I want to share. This is core mining. Core mining is a gold miner. And as you can see, it went from something north of 22, almost 23, boom, crash to 19 or sub 19 in one day. And that was a rude, rude shock. And I lost money on core mining. And when I lost money on core mining, I was shocked because as you can see, MACD was above signal, and using my algorithm, I started buying a lot of core gold and it just came crashing down. And then I looked at Hecla mining. Hecla mining is also a gold trader. They also show that nice ratchet up and a sudden fall, but I made a good chunk of money on Hecla mining. Newmont Gold, you can see that the graph is starting to get stretched out. Newmont Gold also had a nice ride up where the MACD stayed about signal for a very long time and suddenly came crashing down as gold prices came crashing down. And I made a good chunk of money on Newmont Gold. And so I started understanding, and this was the reason why, if you remember my comparison between my portfolio to NASDAQ, there was a very sudden correction in my portfolio. That's because all the gold stocks sold overnight. And when all the gold stocks sold, my gains became realized gains, but my performance of the new money that was in the bank did not match NASDAQ. And so that created a little bit of a conundrum for me. But more importantly, my stop limits worked very well for Hecla and Newmont because I made 25%, 40%, but I lost 8% on core gold, even though I was up a significant amount. And I tried to understand, wait, that doesn't make sense. How could it be? They all grew the same amount. However, I lost money on one of them, made money on the other two. What adjustment should I make? Well, here is what exactly happened. This is core gold. As you can see, I opened my very first position somewhere around September 9th. And you may remember, every time the stock goes up, I buy. When the stock goes down, I don't buy. When the stock makes the previous trade profitable, I buy again. That was my simple algorithm. So I would just keep going buy, stop, buy. That is exactly what was going on, except I got a little too excited and my greed set in. As the days progressed, as October rolled in, if I originally owned, I'm making simple examples here, if I originally owned $1 of Hecla and I kept adding 5 cents, 5 cents, 5 cents all the way here, by now I own $3 of Hecla. And I thought, wow, this is going too well. And so I started adding 20 cents on every up day. And by this time over here, I now have $6 of Hecla, and most of the purchases in this area were over allocated. I was top heavy. And when that crashed, these losses were higher than the gains of the tiny 2 cents, 3 cents in this area of the curve. Core gold punished me. I lost 6%. So the lesson I took from there is interesting. If I increase the weight, the allocation per day, I'm going to lose. Now, how did it so work out in Hecla? And the answer is Hecla evolved from August through October, and I'm going to go back one page, pardon me, and core gold evolved from September to October, barely 45 days, and my allocation was very heavy towards the end. And core gold, you can see, even though Hecla crashed, the number of times I had bought above the trailing stop was far and few. And so my lesson is I can't keep the trailing stop a little too close, and I have to have equal allocation. And then I went to Newmont, and you can see Newmont went from May to October. So these three positions that I bought in May had accumulated a huge amount of profit by the time I sold it here, that this profit made up for a whole lot of these 3 cent, 2 cent buys, and my trailing stop was very, very close. So here is the lesson I take from it. I need to do equal allocations. You do you. I would love to learn whether you buy the same amount on progressive days or you increase or decrease your allocation. And so my algorithm lessons are to have, once I reach a certain gain, it could be 25%, it could be 50%. I'm going to make the trailing stop very tight. So if it falls by more than 3% or 5%, I just immediately sell, and I'm not going to be greedy. Sometimes I may also have to set trailing stops wider if it is in the initial days, but as I start increasing gains, I'm going to make it tighter. Now I do have a greater discipline now in setting my allocations equally. Now sometimes I make mistakes. I forgot my own lessons in Robinhood. Here is Robinhood. The stock goes up, up, up. I keep buying. Notice the stock is crashing, and here come more buys. And I was pinching myself. That was stupid of me. So when I kept buying as the stock went down, and the trailing stop immediately released the stock and sold, I made huge losses on Robinhood. And so I'm going to stick to my knitting and only buy on days that the stock is appreciating and set close trailing stocks. Because what it also does is it creates what are called disallowed losses. So when you sell where you have some losses and some gains, you can take those losses and offset the gains unless you turn around and buy that same stock again. So if there is a crossover buy point for Hood and I bought Hood again, within 30 days, I'd get wash losses, and I learned that lesson the hard way. So here is where my holdings are. Number one, my dogs, and I want to start with my dogs and duds first. Bloom Energy, Modine Manufacturing, these have kind of punished me lately. Calmain Foods is my old faithful, but that has gone down quite a bit. However, I do have stars like Protagonist Therapeutics, IDCC, PSTG, Google. Flex has done magically, and I have bought Flex almost every day for the past 60 days on every up day. And so I'm learning a lot of discipline and making sure that I only buy on up days. Target is very fascinating to me lately. I keep, allocating to Target every day. So we'll see where all of this goes. Some of these are new names here: L3 Harris, Thermo Fisher, Raytheon, and these are all in here for specific reasons based on their recent trends. And you can see I also have other stocks such as Viva, which is new, Viatris, which is US based pharmaceutical. Some of this is positioning against tariffs. So I'm doing my own kind of logic here. I have to adjust stop limits every day, which is very painful. And so I am working with the developer to automate stop limits so I don't have to do it manually. And I'm also preparing for quantitative easing. That is my strategy. Even a broken clock is right twice a day. What is your strategy? How do you do allocations? I would love to learn from you. Thank you for your kind participation and listening.